The average UK home price just hit £299,862, yet millions of homeowners across Britain are waking up in cold sweat, and this number could be the calm before the storm. What if the collapse you've been warned about isn't coming, but has already quietly begun? Stay with me to find out what's really happening under the surface of the UK housing market and why your home, your investment, or your future move could be at risk if you miss what comes next. Hi everyone, I'm Housing Pulse UK, and today we dig into UK property, investing, and real estate trends so you can stay ahead of the curve. In this video, we're breaking down the real reason behind the growing panic among homeowners across the UK, why prices might collapse, and why that could be the start of something much bigger. We'll walk through the latest data, what the big players are doing behind the scenes, and crucially, what you should do if you're thinking of buying, selling, or holding. If you're serious about the UK housing market, stick around past the halfway point, because the closing section will reveal actionable moves amid the chaos. Let's set the scene. The UK housing market in 2025 is at a weird crossroads. Official data shows that as of August 2025, the average UK house price was £272,995, up 0.8% from July and up around 3% year-on-year. But another major source, the Halifax House Price Index, reported a significantly higher number, around £299,862 in October 2025, with annual growth of only 1.9%. And then you have the nationwide index, showing more modest growth and some conflicting monthly moves. So we already have a puzzle. Different indices show slightly different levels, different growth rates, sometimes flat or even falling in specific regions.
Why does this matter? Because when the broad market can't agree on where it's going, that often signals uncertainty, a hallmark of a market shift. Consider London. Average property around £566,000, yet annual growth is 0.3%. Meanwhile, in the Northeast, annual growth is 6.6%. On one hand, you have strong pockets of growth. On the other, you have major stagnation or decline in high-price areas. So here's the big question hitting homeowners. If prices are stalling in London in the southeast, historically the lead indicator for the rest of the UK market, what happens when that pressure migrates? We need to understand what's really driving things, because the headline numbers don't tell the full story. They contain hidden tensions. Let me introduce you to James in Leeds. James bought a 3-bed semi in the Northwest 5 years ago, expecting to build a rental portfolio and retire off rent income. He figured he was safe. After all, up north growth had been strong. But in 2025, James is facing something unexpected. His property's value has risen modestly, yes, but his rental yield is squeezed, his mortgage costs are creeping, and there's a sense that the market's changing. So what's happening behind the scenes? Several key dynamics. First, shifting demand and affordability. Mortgage interest rates remain elevated compared to the ultra-cheap era. Though base rates are stable, borrowing costs from many buyers are still high. Affordability, for first-time buyers, for upsizers, for landlords, is under strain. With everyday costs also climbing, inflation, bills, the wealth effect of property ownership is weakening. For James, this means fewer properties he can buy. For his tenants, it means rents might stagnate. For the market overall, demand is becoming patchy.
Second, regional divergence and the early warning of London. When the capital and the prime south start sputtering, it often flags the rest of the market is next. London's annual growth of minus 0.3% says the top of the pyramid may already be under pressure. If prime London flattens or falls, it can ripple out through investor sentiment, national finance flows, and even regional pricing.
Third, policy, budget uncertainty, and investor behavior. There's a growing sense among buyers and sellers, wait for the budget. Rumors of property tax changes, capital gains tax extensions, changes to buy-to-let rules. These create paralysis. Fewer deals happen when policy is unpredictable. That's exactly what James is feeling, a hesitancy to expand his portfolio because what's next? And investors, they're watching. Some foreign money that once rushed into UK residential property is less active. Large developers are slower, and the easy gains environment of recent years is vanishing.
Fourth, supply changes and quality bifurcation. Homeowners like James are finding there's a growing gap between top-quality homes in prime locations, which still move reasonably well, and average homes in less desirable areas, which face longer times to sell, more discounts. This means for buyers, opportunity. For sellers, caution. For homeowners thinking to downgrade or realize equity, it means their expected wind-up may not arrive as planned. Here's the record-high detail. According to Halifax, the average UK home price hit £299,862 in October 2025. Sounds good? But the annual growth is only plus 1.9%. That means we are at record price levels, yet growth is almost flat compared to the years when plus 10 to 20% gains were routine. That sets up a dangerous scenario: high base, low growth. When prices stop rising fast, many homeowners lose their equity cushion. When a shock hits, rate rise, job market tumble, policy turn, they're more exposed. And here's another surprise. Across the board, flats and maisonettes are under more pressure than houses. The gap between house prices and flat prices in the UK has reached a 30-year high. So if you own a flat or are thinking of buying one, the risk dynamics are different, and in many ways, harsher. And the worst part, the next shock might not come from interest rates alone. It could come from tax policy or from employment. Because if jobs weaken, affordability collapses, and a ripple becomes a wave. Now let's pivot to the hard numbers, because storytelling gives you the narrative, but the data gives you the stakes.
Annual growth rates are sliding. As of August 2025, the UK average price rose 3.0% year-on-year. By comparison, in previous years, growth was much higher. Halifax's latest figure, annual growth of only 1.9% for the average UK home in October 2025. What this means, the market is still moving up overall, but the pace of growth is slowing significantly. That's a key warning sign. High valuations with low growth equals limited buffer. Regional contrast. Northeast England, annual growth 6.6% by August 2025. London, annual growth minus 0.3% by August 2025. Average property, £566,000. UK average, £273,000 by August 2025. Interpretation: regions with lower entry prices and stronger demand are outperforming, but prime and high-price markets are stalling. That often means risk is concentrated where valuations are highest. Property type divergence. Flats or maisonettes, negative or very low growth. For example, average flat or maisonette in England, £225,000 in August 2025. Annual change, minus 0.8%. Detached, £477,000 in August 2025. Annual growth, plus 3.2%. So the gap between housing types is widening. For an investor or homeowner in a flat, risk is higher. Conflicting indices show uncertainty. Halifax says plus 0.6% monthly rise in October 2025. Nationwide reports plus 0.5% monthly rise in September, annual plus 2.2%. Yet earlier months show flat or minor declines in some regions. What that means, even the experts aren't aligned, which signals weak conviction in the market's direction.
Contrast winners versus losers. Winners include homeowners in the Northeast, Northwest, and some regional cities, still seeing healthy growth, catching up. Owners of detached homes in good locations, still seeing modest gains. Losers or at risk include homeowners in London, Southeast, high-value homes, flats or maisonettes, and homes needing work. Sellers who assumed they'd keep 8 to 10% annual growth, that's unlikely now. First-time buyers with tight budgets facing rising borrowing costs and slower price appreciation. Implication? For many homeowners, the upward momentum they counted on is fading. Connecting. James in Leeds is looking at that data and realizing his portfolio's growth, the margin of safety, is thinner than he thought. If a broader shock hits, rate rise, job market tumble, policy shift, the premium he had might vanish. What if the pressure point isn't in transaction volumes or headline prices, but in what hasn't happened yet? What if sellers begin to panic? What if forced sales rise? What if the soft landing scenario flips to something sharper? Let's look ahead.
Now, for the future. Not just for homeowners, but for buyers, landlords, investors, and even renters who think they're safe. To understand where we're going, we need to break the future into 3 possible paths, and one of them is far more likely than the media wants to admit. Path 1, the soft landing. House prices stay broadly flat, interest rates slowly come down, inflation returns toward target. Buyers regain confidence, the market cools but doesn't collapse. Nice story, except for one problem. The numbers don't fully support it. You cannot have stalling wage growth, high borrowing costs, a cooling job market, sluggish consumer spending, and a weakening London market and expect the entire country's property values to sail smoothly upward. So the soft landing is not impossible, but it relies on everything going right. And the UK economy isn't exactly known for calm waters. Path 2, the slow grind down. This is where things get interesting. Prices don't crash. They don't collapse overnight. Instead, they bleed downward, month after month, region by region, property type by property type. It's death by 1,000 cuts. Here's how it plays out. Flats lose value first. London struggles. Sellers start accepting bigger discounts. More price-reduced listings appear, demand softens, transactions fall, confidence drops, negative momentum begins. This scenario is the most consistent with today's data. Weak London growth, flatlining Southeast, high prices plus low wage growth, tight affordability, mortgage costs still elevated, policy uncertainty everywhere. In this world, homeowners feel poorer each year, even if the fall is small, because the emotional shift is huge. That property always goes up belief, gone, shaken, broken. And once sentiment turns, the market follows.
Path 3, the sudden shock. This is not the base case, but it is a growing risk. A shock could be a sudden jump in unemployment, a sharp recession, a policy change that spooks investors, a global financial event, a renewed spike in inflation, a forced sell-off among buy-to-let landlords. Any of these could tip the market from slow decline to fast correction. Think a 5% drop becomes 12%, then 12% becomes 20%. Not everywhere, but in the most inflated areas, especially London flats, southeast commuter towns, overpriced new builds, and areas with huge price growth in the last decade. If you own a highly leveraged property in these zones, your risk exposure is higher than you think. But here's the twist. Even if prices fall, some people will make a lot of money in the chaos. So what should you do if you're an investor or buyer? First-time buyers, you're entering one of the best windows in years, but only if you play it smart. Do not rush into overpriced properties. Do not stretch your budget. Focus on motivated sellers, properties that have been on the market 60 days plus, price-reduced homes, sellers who already dropped their price, and areas with strong rental demand. You are the one with leverage. Use it. Homeowners thinking of selling? Ask yourself, do I need to sell in the next 12 months? If yes, list early, price realistically, don't chase the market down. If no, hold tight, upgrade smartly, and don't panic sell.
Landlords or investors, you are entering the most strategic property market since 2008. Smart investors will target undervalued regions, look for high-yield pockets, buy in areas with growing employment, avoid new builds with inflated developer premiums.
Hunt tired landlords who want out. This is not a market for amateurs, but it is a market for opportunity. The big question: will prices truly collapse? Here's the truth. A national, across-the-board 30% crash is unlikely. But a 10% to 18% correction in vulnerable regions? Very possible. A 20% fall in London flats? Already quietly happening in some pockets. A stagnant market nationwide for 2 to 4 years? Highly probable. The real danger isn't a sudden crash. It's a slow erosion of value that homeowners barely notice, until suddenly their equity is thinner than they thought. And by then, it's too late.
So, here's the bottom line. The UK housing market isn't collapsing overnight, but the foundation underneath it is shifting, quietly, steadily, and faster than most people realize. We started with the headline, UK homeowners panic as prices collapse, and this could be the start of something bigger. And after breaking down the data, the trends, the hidden pressures, and the probable future, that headline is not fear-mongering, it's a warning. A warning that the UK housing market is entering a new phase, one where the old rules no longer apply, and the next 12 months will define who wins and who loses. If you want to stay ahead of these trends, understand the risks, and spot opportunities before the crowd, make sure you subscribe, because we are entering the most important period for UK property since the financial crisis, and the people who understand what's coming next will shape the future of this market. Thanks for watching, and I'll see you in the next one.